Good afternoon, friends. I'm Sandeep Biani, heading business development and sales for AlphaAccurate Advisors. Welcome to AlphaAccurate Advisors AAA Investor Connect. First of all, on behalf of AlphaAccurate Advisors, I would like to wish you a very happy and prosperous new financial year, 23-24. Friends, we talked about quality, and we at AAA also defined what do we mean by quality. We actually quantified the quality and explained to you how we are incorporating it into our portfolios. Quality is not static, but ever evolving scenario in equity markets. It's not like fill it, shut it, and forget it. We actually need to revisit, reevaluate, and reconfirm that yesterday's quality is still a quality. Else, we will be in the quality traps. To avoid this, we need to be awake, aware, and most importantly, agile. That's the birth of QuAgility. Quality plus agility. To present this, I would like to invite our founder and managing director, Mr. Rajesh Kothari. Welcome, Rajesh sir.
Thank you, Sandeep.
Rajesh, in fact, I'm seeing many new participants in this webinar, and for the benefit of all, I'll request you to please throw some light on AAA's investment philosophy briefly, and then you can proceed for the topic of QuAgility and market outlook. Over to you, Rajesh sir. Thank you.
Sure. Thank you, Sandeep. Good afternoon, friends. Very warm welcome to AAA Invest Connect Market Outlook webinar for the recent quarter. And corporate earnings season has also started. So I think absolutely is the right time to talk about how do we see the future from here on. There are a lot of events which have happened in the global markets. And of course, there are a lot of noise which continues even in the local markets. With that, let me first give a very short brief about how do we basically construct the client's portfolio and what is our investment philosophy. Friends, at AlphaAccurate Advisors, very importantly, our USPs are founders are fund managers. We do not have any conflict of interest, highest levels of corporate governance. One of the few PMS firms in India who have a presence since last 13 plus years. And last but not least, in last 13 years, we have delivered consistent award-winning performance. In this quarter also, we received the award for the best PMS in multi-cap and ranked 2 across all market cap by PMS AI World, methodology by IIM Ahmedabad. We are known for delivering consistent, superior risk-adjusted returns. Our flagship plan, which is called Triple India Opportunity PMS plan, has delivered about 18% plus compounded annualized returns since its inception, that is in 2009. Our another PMS plan, AAA Focus PMS plan, has also delivered very good returns since its inception. And our last recently introduced PMS, which is AAA Budding Beast PMS plan, a mid and small cap offering, has also outperformed the benchmark significantly since last 2.5 years. In one line, if I want to summarize our investment philosophy, it is considered protect capital, create wealth. Protection of capital is something prima facie most important. It is of paramount importance before anything beyond the capital in terms of the wealth creation. And with that, let me share a few of my slides to make it easy to understand from investors' perspective. Please give me one moment. As I said, protection of capital is of paramount importance. And to protect capital, what is most important, therefore, is to manage the risk while managing your hard-earned money. And to manage risk, we have a DST approach, diversification, staggered investment, and last but not least, disciplined exit strategy. We strongly believe that risk like governance, technology, and business cycle risk can be mitigated only through diversification. And I keep sharing example, whether it is the India market or whether it is a global market. For example, if you are a pharma company and if that pharma company receives US FDA import alert, definitely stock will go down by 30, 40, 50%. Or even for a global automobile company like Volkswagen Global, one auto emission norm scam and stock is down 40 to 50%. Or companies like BlackBerry and Nokia, which were the blue chip companies and then turned the bankrupt companies. Or there are many companies like, for example, MTNLs of the world and Bales of the world, where the business cycle went against them. And despite the companies were great companies, they became 30, 40, 70% wealth destructor. Can you predict the governance? Can you predict the technology? And can you predict the business cycle? Answer is maybe not. And that is the reason why we strongly believe that diversification helps you to absorb any damage which may come when you are making investment into any business. Second important thing is staggered approach. We do not believe in model portfolio. I'm sure many of you would have experienced that at times we take little longer time to invest your money fully. So we buy today what we like today. And third, the most important thing when it comes to our investment management, it is a disciplined exit strategy. And of course, I will take you through in detail what I mean by this. But in a nutshell, we strongly believe that buying right is one part of the investment management. Another important part is to make sure we also exit at the right time. In terms of stock selection, we are very effective called 3M investment approach: market size, market share, and margin of safety. Buy the businesses where the size of opportunity is huge, so that if you go right, you make a multiple wealth creation. It's a huge wealth creation. But it is a second M, which is another USP of AAA portfolio, and that is buying the business which are market leaders. When you buy leaders, they can withstand the storms. When you buy leaders, you can participate in growth. And that's the reason why it actually not only helps in creating wealth, but when you buy the leaders, it actually helps you to protect the capital as well. And third M is nothing but margin of safety, nothing but the valuation. Price is what you pay, value is what you get. We make sure that the companies what we identify, we buy at a reasonable valuation. In fact, by following this approach of 3M, market size, market share, and margin of safety, we buy businesses which are sectoral leaders, backed by the best of the management, best of the governance, and best of the financials. But that is not enough. On top of it, we make sure there were very strong earnings growth. For example, there are many companies which may look the great companies, but they may not offer the great growth. Like, for example, Castrol is a great business, but it may not offer you 18-20% long-term sustainable earnings growth. And therefore, it may not be a great investment. So we make sure that the companies what we buy, they not only have the great balance sheet, but they also should offer high growth. They should be able to participate in the India growth story over the next 10 years. That's basically how we construct the portfolio. And once we construct the portfolio, we have agility, of course, which I talk about it, at length in the probably post-market outlook, presentation. And then, of course, we have a disciplined exit strategy. That's how we basically construct the client's money and manage client's money. Now, let me come to the heart of today's topic, the market outlook. Friends, last 18 years, they were like almost flattish years, flattish months rather, for the equity markets. But that's actually a congratulatory performance given the global environment, which has been very, very stormy. But the Indian market, the Indian economy has been quite resilient. Whether you look at any of the fast frequency data point, GST collection, you look at the diesel consumption, you look at the power PLF load factor, you look at the purchase manager indices, you look at the passenger vehicle volumes, you look at the cement production, and you look at the steel production, or you look at e-way bills. By and large, Indian economy is doing reasonably well, given the circumstances where we are in the global markets. And that's a good thing, because historically, Whenever the US and the Western world went into a huge problem, particularly recession and the many other headwinds, India also had its own share of negativity. But this time, in last 12, 15, 18 months, Indian economy has really done extremely well due to a variety of factors, the structural reforms by the government, the PLI and the new incentives provided by the government, the entrepreneur spirit which comes back because of the acceleration of the formalization, the bank balance sheet which are now low leverage, borrower balance sheet also low leverage, and so on and so forth. And we'll talk about it in a moment. In nutshell, Indian economy is doing reasonably well. People talk about, do we think recession will impact Indian market? Is it a Lehman collapse moment? And what will happen to the world? We don't think so. I also shared this slide previously, and I will repeat it this time again. The corporate debt to GDP of India in 2008 was 65%. Today, we are at 51%. Our exports have almost from $167 billion has become more than 3 times to $500 billion. Our inflation that time was roughly about 8%. Today, we are at 5.8%. And most importantly, if you look at the left-hand side, look at how heated the economy was. During 2005 to 2008, it is a very, very heated economy. The non-food credit growth, compounded growth of 30%. But this time, the non-food credit growth is just 11, 12%. So there is a big difference between how the Indian economy was in 2005 to 2008 period and how the Indian economy is doing currently. And therefore, we do not think that there is a risk of Lehman movement for Indian economy. At the same time, the important part is the non-food credit growth is slowly coming back to good double digit. It has been almost, I would say, last 7 to 8 months where we have seen the non-food credit growth finally coming back to good double-digit growth. It has happened after almost 13 years. As you can see here, the 13 years, the non-food credit growth was very, very poor. But finally, after 13 years of holiday, the non-food credit growth has started improving and it has become a double-digit. It means Indian economy is doing not only well, but it is now back to its growth path. And lastly, the valuations. Ultimately, market is a function of what kind of growth it can provide you and at what price that growth is available. Friends, from FY19, and if you look at 1 year forward, the 90% is a growth in EPS. But the Nifty is up only 52%. It means market, the peak valuation was 24 times, and currently you are getting at 19.4 times. There is a good, decent 20 to 25% valuation correction in the market. To put it in another way, in October 2021, Nifty was at its peak around 19,000 levels, and currently we are at roughly 17,500 levels. So 9% is the price correction. October 21 to March 23, almost 18 months of time period. It means 10% time correction, 9% price correction, 10% time correction. It means we are almost 20% below. On top of it, if you put the earnings growth during last 2 years, it has been 20% plus. So in a way, you are actually getting market at 30 to 40% discount compared to where it was 1.5 to 2 years back. And that means market is providing you fantastic entry point at current levels. We strongly believe that the worst of inflation, the worst of interest rates is over. The Indian economy is not having a fear of high inflation or fear of high interest rates. Even in the global market, I think probably another 2-3 rate hikes, which is possible to cool down the economy, which Fed may do, but I think the entire world is aware about it. And from there, even in US market, inflation will go towards the southward trajectory. And therefore, interest rates, maybe after probably 3 to 4 quarters, even interest rates will follow the southward trajectory. So even from the sentiment perspective, even from the, what I would say, from the noise perspective, the headlines, the worst headlines are behind us. The Russia-Ukraine war is almost behind us. The supply chain pressure problem is behind us. The worst of high commodity prices is behind us. The worst of Fed rate hikes, the noise, that is behind us. And therefore, we believe that we are entering into a period where growth is going to revive, where the valuation correction which has happened in last 15 months will not happen from here on. So no risk of further derating. And at the same time, India is going to deliver strong GDP growth and much better earnings growth compared to the many other economies in the world market. And that gives fantastic opportunity for both global investor as well as for local investors to invest in Indian equity market with a time horizon of 3 to 5 years. I talked about this, the valuations are reasonable. And if you look at this chart, 1 year forward price to earning multiple, now we are trading below 10 years average valuations. And please remember, market is all about greed and fear. When others are greedy, you have to be a little bit fearful. When others are fearful, you need to be a little bit greedy. The valuation suggests that right now, the mindset is fearful. And when mindset is fearful, smart investor typically to do top-ups. They do invest in market at such periods because then you can get at times little bit better alpha, little bit more compounded returns over a longer time period. Coming to the sectors, this is the flagship plan, AAA India Opportunity PMS. Here we own 30% banking, 16% consumer, 15% engineering, that is capital goods, auto and automobile about 8%, software is 7%, specialty chemical 5%. We are positive on CapEx theme, the capital goods engineering space, since last almost 1.5 to 2 years. In fact, we had a detailed presentation on why we like capital goods through our webinars. Very, very detailed presentation we made during last January event as well as September event. And we continue to remain bullish on CapEx theme. We believe that there are many new growth drivers for capital expenditure to accelerate: data centers, renewable energy, process efficiency, automation, and many more such factors. Apart from the government-led announcements, whether it is on infrastructure side, whether it is a PLI incentives, all these things put together means better capacity utilization, higher capital expenditure by cement, steel, oil and gas, higher capital expenditure because of the PLI incentive of roughly 1,40,000 crores, and last but not least, new growth drivers like data center, which is going to grow at 30% compounded over next 4 to 5 years, and so on and so forth. So we continue to like capital goods engineering as a space, and we remain bullish on that. Banking and finance, we remain positive. 31% of the portfolio is in banking and finance. We believe that non-food credit growth after a very long holiday, as I talked last time, 13 years of holiday, and now the non-food credit growth is double digit. That's a very, very welcome thing for Indian economy and for Indian banking sector. Of course, the credit cost have declined in last, from its peak of last 5 years, in last 1 year, it has declined, and it is now declined significantly. It means no more provisions requirement. And the net interest margins, of course, have expanded significantly. And if I look at even the fourth quarter, it has been reasonably healthy. So that's the reason why we like banking and finance space. Consumer is a space, we continue to own this space, and within consumer, there is a discretionary and there is a non-discretionary, there is FMCG. And we keep moving between discretionary and non-discretionary depending upon various factors, the underlying demand, the underlying profitability, the underlying raw material cost headwinds or tailwinds, and so on and so forth. Software is one sector which we have been underweight since last almost 14 months. I think we started selling software exactly 1 year back, March 2022. We were negative on software because valuations were at a skyrocket valuations 1 year back. And we said that if the US enters into recession, there is no way that demand growth can sustain at what market assumed 18-20% kind of a growth. We said it is not sustainable, and that's the reason why we underweight software 1 year back, and our call is going right. Specialty chemical, we continue to ride, like this space, but of course, very, very selectively. Earlier, we used to own 9-10%, and then, of course, most of the companies went high to their lifetime high, and we took that as an opportunity to do some profit booking, and here is going to be now bottom up. Automobile and auto ancillary, we continue to like this space. Again, we had a very detailed discussion on this during last webinar, that why we like this space. We believe that the after what I would say lull of almost 4 years, automobile and auto ancillary is now going to report better growth. Demand is coming back. Demand was impacted because of the shortage of semiconductor, which is now getting resolved, and therefore demand now remains strong. Ability of manufacturers to cater to the demand has now improved. The raw material cost environment is now become more benign, and that means more profitability. And at the same time, the premiumization of the product is also happening, and that gives enough opportunity for automobile and auto ancillary companies. So that's basically by and large how we view every sector, and that's how our sectoral allocation. In focus plan also 30% banking, 18% consumer, 15% engineering, 8 to 9% specialty chemical, 7% software, and 5% auto and auto ancillaries. And in budding based, of course, our largest weight is here engineering, 28%, followed by consumer, and then of course banking and finance, and auto ancillary, and 5% specialty chemical. Pharma, as I said last time also we discussed, we remain underweight on pharma since October 2020, almost like 2 years back, and that time we sold, and most of the stocks are now below our cost price. So we bought pharma during COVID period, and then we exited pharma when it went up 60-70%. And software we remain underweight. So that's basically how each of our PMS plan in terms of the sectoral allocation. In terms of performance, this is the performance since inception. So AAA IOP from 23rd November 2009 to 31st March 2023, we have delivered 17.5% compounded annualized returns compared to BSE 500 returns of 11.3%. AAA Focus 12.8% compounding return from 17th November 2014 to 31st March 2023 compared to benchmark returns of 10.9%. And AAA budding based, a mid and small cap offering from Alpha Accurate Advisors, has delivered 23% compounded annualized returns from 1st January 2021 to 31st March 2023 compared to benchmark returns of 17.9%. With that, let me now come to one very interesting topic on which often we have received many questions from the investors, that what is the right way to create wealth with the lesser risk in Indian equity market. And that's where we coined this term called QuAgility. We strongly believe that quality plus agility, that's the need of the hour. Just agility without quality is not going to work. And of course, just quality without agility is also not going to work. And therefore, what is required is a combination of QuAgility and agility, and that's what we've been doing from last 13 years. And I thought to share some secret sauce of how we have delivered 18% plus compounded annualized returns in last 13 years. Friends, how we define quality? As Sandeep said in his opening remark, we quantify the quality. Out of 5,000 listed companies, there are about 800 companies which makes net profit in excess of 50 crores, 50 crores. We put that as a benchmark because it means companies at least achieved something, and there are only 800 companies which has reported net profit in excess of 50 crores. In fact, if you further put it filter of 100 crores, then you get only 600 companies in India out of 5,000 listed companies which makes net profit in excess of 100 crores. And the size of these 50 crores or 100 crores is something very important, because if you are a very small company, 5 crore, 10 crore profit making company, then volatility into currency, volatility into commodity, volatility into tariff barriers, the pandemics, the lockdowns, unlockdowns, supply chain issue, China issue, it can really create huge negative impact on your corporate. But if you identify the company, when company has a size of 100 crores plus, it means revenue of maybe about 12,000 crores of revenue, then it means it becomes a top 600 companies in India. Once we do the profit size, the second important is how can we reduce the risk? Company is great. Based on our 3M investment approach, it is a great company, good market share, king size market share, large profit size. But what about the risk? And then we prefer to buy businesses which are zero debt or buy businesses where the leverage is very low and at the same time cash flow conversion is very high. And there comes about roughly 300 companies which meets those parameters. And out of these 300 companies, after quantifying that quality, we then buy 40 to 50 to 52 companies in our portfolio, which are alpha producer. And of course, we do a lot of deep dive. So that's basically about the quality. Of course, we do a lot of internal checks in terms of the forensic assessment as well as the longevity assessment. We have a 13-point factors for forensic assessment, which can be broadly classified into 4 categories. What are the management practices? That's basically to identify, to assess the governance of the promoters. What is the accounting policy? How consistent they are or how inconsistent they are. That finally basically tell you about the fairness of the accounting policy. The consistency and fairness is something very important. Third is taxation mischiefs. Are they doing some financial jugglery? And if they are doing it, then of course forensic score becomes very poor and we don't buy such businesses. And last but not least, the quality of cash flow, the ability to convert the revenue to cash and then further reinvest that cash to generate the future growth. That's basically, we have a, of course, very detailed 13-point framework, and maybe at some point of time, I will take you through in depth of how we do this, but that's how basically we put a final score, 13-point parameter final score. And based on that, there is a quartile 1, quartile 2, quartile 3, and quartile 4. There are 4 buckets, and we make sure we don't buy any businesses if they do not meet our forensic score. And then comes the longevity assessment. The longevity assessment, again, is about 8-point total factors, can be broadly classified into 4 categories. The longevity of business growth, which will help you to identify whether the revenue and the earnings growth is sustainable, whether the competitive advantage what companies is enjoying is durable, because if it is not durable, then the growth can be at question mark. Second is longevity of returns. What is the underlying business profitability compared to its peer group? Third is longevity of cash flow to identify the financial strength. As I talked, said, we buy businesses, we prefer businesses which are zero debt, zero leverage, low leverage. That's how our entire portfolio gets constructed. And last but not least, ability to reinvest into the business. A business might be great, but if it is a sunset business, if it is a dying business, then there's no point. You need to have a cash flow, and at the same time, you should have opportunity to reinvest that cash flow for the future growth. Based on these parameters of 3M investment approach, market size, market share, margin of safety, identifying the right companies, judging them on forensic assessment, giving them the longevity assessment, that's how the portfolio gets constructed. Walking the talk. Let me now tell you, that's the process. Let me now show you the outcome of that process. And I have put here each of my 3 PMS plans to make it very, very easy for the entire audience. If I look at my AAA India opportunity, the flagship PMS, all our portfolio companies are large by profit size. 67%, they have a 500 crores plus reported net profit. 93% of the portfolio companies, 100 crores plus reported net profit. Please remember, there are only 10% of the universe which qualifies this criteria. So entire our portfolio meets that criteria. How is the balance sheet? 77% of the companies, zero debt, no leverage, and 18% debt equity less than 1. How is the earnings growth? Significantly better than the Nifty or the benchmark. And how is the return on net worth? 17% plus return on net worth. And that's true even for my mid and small cap and even for my focus PMS. Like if you look at my budding beast, the name is mid and small cap, but actually all portfolio companies are market leaders with all portfolio companies are oligopolies. All my portfolio companies are 50 crores plus net profit. 70% roughly of my portfolio is 100 crores plus net profit. They are called mid and small cap because of the regulatory definition, but they all are debt free. 74% of the portfolio companies are debt free. They all enjoy very high return on net worth, 19%. And of course, they are growing very fast because being mid and small size, their ability to grow is very fast, about 47% earnings growth. And same is true for my AAA focus PMS plan, a beautiful 30 stocks curated portfolio, primarily focusing on large cap and mid cap. Here also, all companies are debt free. They all are 100 crores plus. Many of these companies are 500 crores plus in terms of profit size. They offer high earnings growth and of course, high return on net worth. So first I explain you how we define quality, and then I've explained you how we walk the talk, what we do, what is our process, and what is the outcome from that process. Something very important, a topic which is our USP, and I love to discuss on this topic. And this time we thought to discuss at length on exit strategy. Friends, discipline exit strategy is a hallmark of Alpha Accurate Advisors investment management. When we exit, first, when there is a automatic rebalancing of weightage, so if the stock becomes 3% to 5%, is a mid-cap stock, we make it again 3%. Second, a company no longer meets our buy and hold criteria. It means the growth assumptions which everybody is making, we believe it is not going to grow to that level in terms of the earnings growth, the revenue growth, the business growth. And if it is not going to grow compared to what we thought it should, we need to get out of it. And third, very important, when it doesn't offer the margin of safety. The valuation criteria, their valuation criteria suggests that it is a very high multiple and the valuations are not in our favor. We need to exit. Fourth, when we believe that company will no longer give us good double-digit handsome returns for the longer term. And last, when there is a relatively better risk-reward opportunity. These are the 5 reasons when we exit from the company. Because we strongly believe that the only constant is change. And if you look at the McKinsey report, in US S&P 500, the age of a company, the lifespan of a company has reduced from 90 years, 90, in 1935 to less than 18 years. And this is probably report 3 years back. As I speak with you, probably it might be even now less than 18 years. And that means exit is critical. In fact, 3/4 of Sensex has changed in last 16 years. The DLF, Jaiprakash, MTNL, Vale, Reliance Communication, Reliance Capital, and many more such companies. They all are part of Sensex, but they all had to exit because of a variety of reasons. So buying businesses is of course important, but selling those businesses when we think the growth is not going to come in our favor, or we think the margin of safety is not going to be in our favor, we need to press the sell button. And why this exit? And that's what the detailed discussion we are going to do right now, the agility. Why the agility is required? Why a buy and hold approach? Fill it, forget it, fill it, shut it, forget it. Sandeep talked about in his opening remarks. Why it is not going to work? Because of the simple reason. And here I'm giving in front of you the last 10 years earnings growth. And I'm just plotting the 6 sectors, which are very large sectors: automobile, banking, consumer, capital goods, pharma, and software. The red means poor, yellow means average, and green means great. Look at the earnings growth. There is not a single sector where everything is green, green, green. There is not a single sector. In fact, the so-called pharma, which is a defensive, look at how volatile that growth is. FY 15 -6. FY 17 just 7%, less than India GDP. FY 18 -11. FY 19 only 6. FY 20 only 8. So 1, 2, 3, 4. 4 years of poor growth. 17, 18, 19, 20. So-called defensive sector. Or for that matter, let me talk about consumer, a sector which everybody thinks it is a consistent, but there is nothing consistent about it. Look at FY 14. The growth is below India GDP growth, only 8%. FY 16, only 9%. FY 18, only 5%. FY 21, -3%. It is not that this consumer sector is growing at 15-18% compounding returns. No, the growth, if you look at the growth cycles, before 8%, it is 15%. It is not 30% and 8%. It is 15% और वापिस 8% हो गया. And then again went up only 13. It even went up 32. And then again came back to single digit 9. Every sector is cyclical, of course. If you look at automobile and if you look at the banking, the cycles are, of course, they are deep cyclical stocks, and therefore the earnings growth are much more volatile. Or for that matter, look at capital goods, 3 years of degrowth, then flat growth, and then double digit growth, 3 years, and then again negative growth, and then again positive growth. Or look at, for that matter, software. FY15 growth is only 10%, 16 only 12, 17 only 11, FY18 only 4, and FY20 again only 4, and FY21 only 10. Again, suboptimal growth, below the GDP growth of the country in nominal terms. And because the earnings growth are volatile, the operating cycles are volatile, of course, the market cap of the sector also mirrors the volatility. There is not a single sector, as you look at the index performance chart, will gives every year 20%. Not possible. There is not a single sector which can give you every year 20%. No, it's not possible. Look at the famous consumer sector. FY13, only 11%, and then only 12%. In 1 year, then it goes to 44, but then it becomes negative 13. FY20 again negative minus 37. Or for that matter, pharma, or for that matter, software. Look at FY16, minus 12, FY18, minus 14, FY20, minus 18. So if you hold on a stock, it goes up 10%, it comes down 18%, then at times it goes up, at times again it comes down. Cycles are volatile and markets are much more volatile. Why the volatility? The volatility in business cycles is because of the changing global environment. Crude price, currencies, geographical, geopolitical regions, the tariff periods, and of course the underlying demand itself. They change so fast, and this is the last 10 years. I'm sure the next 10 years are going to be more volatile than last 10 years. And therefore, a fund manager needs to be agile to make sure to protect capital and create wealth. What we have done in this period of volatile period, and I'm just showing in front of you the last 3 years. Pre-COVID, that is February 20, March 20, COVID entered India, then unlocked down around September 20, and then of course it becomes a normal period. And what we have done. So to give you a perspective, automobile, we were overweight, pre-COVID about 7%. And early March, before COVID entered India, before lockdown, we reduced and became underweight. 7% weightage we used to own, we reduced to about below 5%. And then the unlockdown started, stocks prices went down. We said it is an opportunity. We increased our weightage to about 7%, 8%, 9%. And from there, by and large, we remain bullish on automobile and auto ancillary. As we speak with you currently, from last almost 1.5 years or so, we are holding 8 to 10% automobile sector. So it has been very rewarding because the auto index is up if you look at it last 18 months. Banking, we have been kind of a neutral weight by and large, or underweight by and large. And as I speak with you currently, we are holding about 30%. Of course, the benchmark weightage is 31%. But don't go by benchmark weight, and I will tell you in a moment how actually we have done within banking. Consumer space, we were basically neutral pre-COVID, and then COVID entered India. We increased our weightage, and from there, we are almost neutral to positive compared to benchmark. Capital goods, throughout last 3 years, we have been bullish on this name. This is space on which we are gung-ho, and today, most of the companies what we own, they are at their lifetime high or near to lifetime high. They have received the best of the orders in last 3 years. They have received the best of the orders from Europe +1 opportunity in last 3 years. They were beneficiary of automation in last 3 years. They are beneficiary of China +1 in last 3 years. Pharma, we have been bullish on pharma since pre-COVID, during COVID, and we made big money in pharma during February to September 20. I still remember we were holding about, we almost made pharma 14% of my portfolio, pre-COVID. And in 6 months, stocks went up 70%. And from there, we exited. And of course, then we became hugely underweight. As I speak with you right now, we are holding only maybe 2% or 3% pharma in our portfolio. Software, by and large, we were underweight. In between, we became neutral weight. And then March 22, we were overweight. And then March 22, we actually sold it because valuations were against us. And from there, we were underweight. And that call again went right because the valuations have come down and the earnings growth have also come down. Let me explain you a little bit more in detail with few case studies. And let me take my first sector, the sector on which we have been bullish from last 3 years. So why we became bullish? So there are a number of factors. And if you look at 2013 to 2020, that is a 7-year time period where your gross capital formation was not that great. Metal prices growth was only 7-8%. Inflation was very low. Cost of debt was high. And corporate credit growth was muted, just 3%. CapEx utilization was below 75%. Not a good time for any CapEx stock to do well. But in 2020, we became bullish on this thesis on capital goods because metal prices started moving up, which is important because then steel sector is a huge CapEx spender. Inflation from 1.6 became 5, 6, 7, 8, which is also important because that's how company actually makes money. The cost of debt, on the other hand, it reduced. It means it gave power to corporates it improved the corporate India balance sheet. Their profit growth improved. Their balance sheet, they repaid a lot of debt. The cost of debt also came down and it really helped the borrower's balance sheet. And last but not least, we said this is the bottom of corporate credit growth. I'm talking about February 2020. It was just 3%. And we said from 3, it can only go up to 10, 12, 15%. And as I speak with you, in last 18 months, it has always kept improving. And today, we are at 15% non-food credit growth. 5, 6 consecutive months where after 13 years, the non-food credit growth became double digit. So that's what our thesis. Our thesis in Feb 20, this has to go up from 3% to double digit. And that's what right now is happening. And accordingly, how is our portfolio weightages of capital goods? So this is the March 2020. Because of COVID, we became a little bit cautious. We reduced to 8%. But then as our lockdown started, we increased our weightages. Capital goods index in last 2 years went up almost 40, 50%. So 9% weightage become 13%. And of course, part of it is also due to the appreciation of the underlying stock prices. So that's how we have played the capital goods in our portfolio. Let me show you one other example, the banking sector. We were holding 26% pre-COVID, but COVID entered India. And we said, if any lockdown happens, the first thing what hits the overall Indian economy and credit will hit the most and credit cost will also go up if it becomes a major problem. So we sold from 26, we became 18%. And then the lockdown started. We said it is not going to be a major problem. The credit cost is going to remain not that big problem. The non-food credit growth will improve. The loan book growth will improve. People are not going to, people are actually willing to buy more and more cars, more housing, and so on and so forth. So there are many growth levers, and therefore we kept increasing weightage. As of now, as I speak with you, we are roughly 30 to 31% into banking. One more example, IT sector. We were about 5% and we made 3. And then from 3, we kept moving up because of the cloud and digitalization wave. We made it almost 13%. And from there, last year, March 22, we sold and we made it 7 to 8 to 8.5%. Why we exited? That's the reason on the left-hand side. 1 year back, March 22, the tier 1 stocks were trading at, when I say tier 1 means Infosys, TCS, Wipro, HCL Tech, and Tech Mahindra, 5 stocks combined. They were trading at 35 times. Pre-COVID, they used to trade at 19 times. 35 versus 19. That's big, almost double. And shockingly, the mid-cap stocks, pre-COVID, they were trading at 19 times only. And then 19 became 66 times. And we said, these valuations are not sustainable because Russia-Ukraine war already started. I'm talking about a March 22. Inflation was going up. Fed already announced that they are going to hike the interest rates in a big way because they need to cool down the economy. I'm talking about the US 1 year back. And if that happens, it was written on the wall, the US economy will enter into slowdown. And if US economy enters into slowdown, everybody assumed 18-20% growth to sustain for next 3 years. And we said it is not possible. So you are taking two risks. You are assuming 20% growth. That's what market was assuming for 3 years. And at the same time, market was giving it 35 times tier 1 valuations. Both are at the peak valuations and peak growth. If either of it, there is a puncture, definitely stock price will come down. And that's why we reduce our IT sector weightage from 13% to 7%. Few stock examples, like for example, we bought Sundaram Fasteners based on 3M approach. Market size is huge. Of course, they are market leader. And at the same time, stock was available at almost like 12 times price to earning multiple. I still remember we bought it around 300 or something like that. And we made in a matter of less than 2 years, we made 140% returns and we exited Sundaram Fasteners. Britannia Industry, another example, 151% increase, from our purchase price, and then we exited because people had a lot of biscuits and the margins and profits went up through the roof. But we said it is not going to continue forever. Another company which we made huge money, that is Dixon Technology. We bought it in actually this error. So we bought it in the month of March 20 when the stock price was under pressure, and we made almost 4 times from our purchase price. We recently actually exited. There is a typo error. We exited in about 2 months back. Because why we exited? The reason why we exited because the underlying consumer is under pressure. The washing machine demand, the refrigerator demand, the air condition demand, the mobile demand, global demand is under pressure. Dixon is best of the company, 3M approach, largest player on a huge growth path, but the customers to whom Dixon is catering, they are under slowdown mode because of slowdown in demand globally. And therefore we say the valuation as well as earnings growth will not come true, at least for 4 to 8 quarters. And that's the reason we decided to exit the Dixon. So these are our recent exit about 2-3 months back. We sold it at around 3,900. And I think current price is roughly about 2,800. Few other examples, specialty chemical. We kept talking about specialty chemical. We had a detailed webinar on why we like specialty chemical exactly about 1.5 years back. We bought RT Industry that time, February 2021, the largest player into specialty chemical, and we made 140% returns, and we exited on April 22. Or for that example, DV's Lab, one of our favorite company in pharmaceutical. We bought pre-COVID, November 2019, at about 1,600 rupees, and we sold in May 22. Everybody knows Divi's, I'm sure, is one of the most respected company in Indian pharmaceutical sector. That why we sold? We sold because the good part of Divi's profit, there was a lot of one-time opportunities because of the pandemic COVID-related drug. And we said this COVID-related drug profit opportunity is not going to continue forever. And the valuations were 45, 50 times price to earning multiple. And everybody assumed that that kind of growth will continue for next 3, 4, 5 years. And we said that is not going to happen. The margin of safety is not in our favor. Let's book our profits and let's move on to other better opportunities. That's why we sold DV's Lab. Or the company like Metropolis, that too we made big money and exited once we made 91% returns. One case study, why we bought Metropolis. This is March 2020, COVID entered India. Number of cases of COVID started increasing. So you required rapid test, RT-PCR, and therefore it resulted into improvement in Metropolis patient volume. After the detailed due diligence, both top down and bottom up, we bought Metropolis at 1,400 rupees during April 2020. During June 2020, after we bought Metropolis, net profit went up 44%. stock went up 92%. And in October 2021, exactly 15 months post our purchase, we bought in June 2020. I'm talking about October 21. Unlockdown started across. It was a wave 2 was also over. If you remember those days, wave 2 was also over. And we said we are at the peak of COVID. From here, the COVID is only going to come down. Number of tests will also come down. Patient volume will also come down. And therefore, Metropolis revenue will also come down. And that's the reason why we exited at 2,700. COVID revenue picked out. And what is the result after that? In FY23, company reported minus 5% revenue growth, minus 24% profit growth, and stock is declined by 55%. It is below our purchase price, the cost price, as I speak with you right now. What I'm trying to show is that great company, 3M investment approach, large market size, under-penetrated category. Metropolis is there are only 2 players which are listed, real oligopolies, great business, great moat, identified the growth, bite on a growth prospects, company delivers extremely well, need to be agile, it remains great company, but if the growth is going to come down, then you need to revisit your underlying assumptions, and therefore you need to revisit, should you continue to hold, or should you buy more, or should you exit completely? And after you exit, again, you need to keep reviewing that where are we today sitting? Are we looking at better growth prospects from here on, or is it going to continue to deteriorate? So that's basically, we thought to share few more things in terms of how we actually do research and our deep dive into the company. So that's Metropolis. And last but not least, the QuAgility pays off. And look at our performance. The first column is Triple India Opportunity PMS, 17.5% compounding returns, very healthy alpha, but importantly, strong Sharpe ratio. Higher the Sharpe ratio, better the performance. Low standard deviation, it means less risk. Low beta, it means less risk. Same is true for our focus PMS, 12.8% compounding return compared to benchmark 10.9. Good Sharpe ratio, 0.34. Standard deviation less than benchmark, it means low risk, and beta less than benchmark, it means low risk. Let me tell you about Budding Beast, 23% compounded annualized returns compared to benchmark returns of 17.9. One of the strongest Sharpe ratio, 1.04. Low standard deviation, 15.4. Low beta, 0.77. Underlying theme is take less risk, protect capital, generate more wealth, create wealth. Less risk, high alpha. And that too, doing it on consistent basis, year after year after year, by following 3M investment approach for selection of the stock and discipline exit strategy to make sure that we remain QuAgile in our investment methodology. With that, I would like to end my presentation. Last but not least, I'm sure everybody here knows that, just few good news I wanted to share with you. Of course, our head office remains in Mumbai, and now we have expanded one more branch in Mumbai, that too very close to, where are we right now, Elphinstone Road. We have one more branch now in Bangalore, which is looked after by Suchita Paul. And of course, Sandeep is in head of sales, is based in Mumbai. We have 3 PMS plans, and now we have also launched our alternate investment fund. And across our PMS plan, we offer SIP and STP options. With that, I would end my presentation. Thank you very much for spending your time on this evening, and wish you all the best. Thank you.
Thank you, Rajesh. I'm requesting all to please post your questions in Q&A section. Rajesh, till the time the question queue assembles, a couple of questions. In fact, I got one on the WhatsApp as well. A couple of one is in chat box as well. Mr. Neeraj Thakkar is asking. It's a very personal and a very classic question. Sir, please share your personal journey into equities I'm sure everyone will be curious to know your wonderful journey, at least some milestones in your career and how you decided to take plunge into PMS. Thank you. This is the question from Mr. Neeraj Thakkar.
Hey, hi, Neeraj. I think it's a wonderful question, and I don't think this forum I will be able to justify the answer because it's a very long answer. But to put it, maybe just 2-3 lines on this thing is equity was my passion. So that's how I entered equities into market since last 27 years. 8 years I spent on research, trying to understand what we need to do, how we need to do, how best we can identify the good things. And then I basically entered into the buy side of the business. I was fund manager with DSP BlackRock Mutual Fund. And after getting all the awards, I said, let me learn when to exit. So I joined a hedge fund to learn the ropes of selling the stock, selling the market. And then in 2009, I decided to start on my own because that's what my final objective was, to be an entrepreneur. And God has been kind. It was a wonderful journey. There are many milestones. And I think the biggest milestone is to have the trust of 400, 500 plus families, managing their hard-earned money, and they are keeping faith in AlfAccurate Advisors and in me personally. That means a lot to us, and we continue to strive to deliver consistent, superior, risk-adjusted, and with the best of the efforts, with best of the integrity. That's what we offer on table. So very short answer. Maybe at some point of time we'll discuss in detail, so that's short answer from my side. Thank you, Neeraj.
Thanks, Raj. Another question from Mr. Amit Desai. What will be expected PMS returns in next 3 years? As you said, excellent opportunity in India.
Good question, Amit ji. I think if you ask my personal view, normally India GDP growth, one can say 10 to 11%, 5-6% real GDP growth and 5% inflation, that gives you 11%. Because of the acceleration of the formalization, the unorganized sector is losing because of the compliance and government policies. It means organized sector can do a little bit better than GDP, maybe 12 to 13%. What we do in our PMS, we buy the best of the companies, the oligopolies, the market leaders, the sectoral leaders, and generally speaking, they are growing at a faster rate than organized sector, maybe 14%, 15%, 18%, 20%. And if the revenue growth is 14, 15, 16, 17%, most of our portfolio companies are zero debt, zero leverage, and high ROE and high ROC and high growth. Their earnings growth can be 15, 18, 20, 22, 25%, depending upon market cap, and it varies from company to company. Market is a mirror of earnings growth in the long term, and therefore, I strongly think that the upside from here on can be a little bit higher compared to what we have seen as a country, as a Nifty. Last 8 years was about 9% CAGR returns, correct? But I think the next 3 years are going to be better growth, and therefore returns also can be better than what we have seen in the history, considering the valuations are in your favor, considering that there is a time correction already happened, considering that the worst of the news flow is probably behind you. So I am optimistic, and I think the corporate balance sheet has been deleveraged, the risks are reducing. Yes, there are always short-term volatility, but if anybody has a 3 to 5 years view, I think this is a country on which definitely you can bet your money and do right asset allocation in equity. I'm sure it will be worth investing at current valuations.
Next question is well explained. QuAgility, agility, yeah. So what parameters you monitor while deciding to exit the stock?
For exit, again, let me share my screen with you to make it, easy for person who has asked this question. Give me one moment, and screen will come in front of you. Which slides? Maybe it was so basically, by the time the screen comes, let me. Give me one moment. Sorry for this.
Yeah.
I think it will come. Okay, so exit first for the rebalancing of the portfolio. For example, if I bought a small cap and 2% because of the price appreciation has become 3%, we again reduce to 2%. So that is first, auto rebalance. Second, let's assume I have assumed that a company which I bought, like for example, Metropolis, I've decided that I bought this company and I think this company will do 25 to 30% earnings growth. After that company delivers, my earnings were 25 to 30%. And I revisit my thesis and I said, hey, the COVID is peaking out. And from here, company growth will not be 35%, but it will reduce to 0 to 10%. If the growth is going to come down, definitely I should not hold on to the company. And therefore, I decide to exit. Third, company no longer meets our valuation criteria. For example, we had IT stocks in March 2022, and the valuations of mid-cap IT stocks became 3 times higher compared to what they used to be pre-COVID. Growth was not 3 times higher. So for example, a mid-cap IT company was trading at 45 price to earning multiple. Before COVID, it used to trade at 12 times, 13 times price to earning multiple. It means this valuation cannot get sustained. And if I have a fear that valuations are not going to sustain, I need to exit. Fourth is when I think that the company will not give me the good returns from here on because of the variety of factors, then I reduce. And last is I have a better alternate opportunity. So for example, I sold IT stocks and I bought capital goods because I said capital goods can offer you better growth and better margin of safety, and therefore switch from one company to other company. These are the reasons or the ways by why we exit the company.
Good.
I hope
Thanks.
that answers your question.
Thanks, Rajesh. In fact, the next question is on capital goods only. You were ahead of time in capital goods. What is your stand now? Is capex peaking?
Good question. I think the capex story will continue to do well. If you ask me, fundamentally, after a long time, the order inflow growth has started. From last almost 4 quarters, we are seeing very strong order inflow. From where these orders are coming? One, you have a traditional growth areas, and then you have a new growth areas. What are the traditional growth areas? Road, port, railway, power transmission. They are growing at 6, 9, 10%. It's okay-ish growth. It's not very strong growth. But then there is a data center. India is going to increase data center capacity is going to become 4 to 5 times in next 5, 7, 8 years. 30% compounding. Then there is a renewable energy. That is going to become 3 times in next 7 to 8 years. Again, 25% plus compounding. Then you have automation. Then you have a process efficiency. On top of it, you have a Europe plus one opportunity because there are many European engineering companies which are planning to switch their facilities to India. That will lead to high capacity utilization for Indian companies. On top of it, government has announced the PLI for the overall various sectors. Roughly about 1,20,000 crores is the total incentives government has announced. It means more capex will happen related to such sector like electronics. We became the large exporter. And of course, the traditional sector like steel, cement are also experiencing strong capex. So I think the capex story will continue. The capex growth will continue. The order inflow momentum will become strong. And the borrower, the corporate India balance sheet is very healthy. I think it is not like best of the time. It is continue to be better. And maybe after a year or so, probably it will be probably the best of the time where, you will see capex utilization reaching 80, 85, 90% and huge capex then will start. So I think we are in a sweet cycle. I remember 2003 to 2008, BSE Capital Goods Index went up 15 times in 5 years. So I think we have still some steam left, so that's my view on the capital goods.
Okay. Thanks, Rajesh. Another question is on banking sector. Banking sector reporting strong growth and low NPA. Is there any risk due to high interest rates like SVB?
Okay. First of all, banking sector, as somebody has rightly pointed out, that there are always good lenders and bad lenders, correct? So there are companies which are very, very prudent in terms of to whom they are lending. And there are companies which do reckless lending. Please remember, lending is the easiest business in the world. I mean, you can lend, it's very easy to lend. But the worst part is the most difficult business to do in the world to get it collected at your time. Correct? And therefore, you need to be very, very selective that what kind of banks you are buying and what kind of management practices they have. That's, of course, of paramount importance. Having said that, on macro level, we do not see any kind of a crisis at macro level for Indian economy in terms of the banking sector. Our regulators are very strict. Regulations have improved a lot. The disclosure norms have improved a lot. The discipline, not only in private sector bank, but also in public sector banks, have changed a lot in last 10 years. And therefore, we are very positive on banking sector, and we do not see any risk of SVB kind events in Indian banking system in a meaningful way.
Okay, thanks. Mr. Bharat Shah is asking, are you taking into consideration of investing in infrastructure and defense companies?
Good question, Bharat Bhai. Basically, we look at variety of sectors within CapEx. We own one of the company within defense space. I think that space is very attractive. Make in India efforts are ongoing and it will further accelerate. So we are holding one of the company in defense. In infrastructure, we are not holding any direct company in infrastructure because it is a regulated sector. There are a lot of risk, government being your customer, and also most of the companies in their infrastructure, they have a balance sheets issues, they have a governance issues. Most of them are high leverage balance sheets. If I look at our capital goods portfolio, our entire portfolio capital goods, they all are debt-free balance sheet. They all enjoy technology as a moat. They are the biggest beneficiary of Europe +1. They are the biggest beneficiary of new growth trends, data center, and so on and so forth. So just infrastructure, we are not that bullish because that space will grow at 5-7%, whereas we want 20-25% compounded growth for next 2, 3, 4 years. So we are not so bullish on infrastructure as a space in terms of directly investing into those stocks. We rather play through their ancillaries who can benefit more out of it rather than the direct companies which are into the infrastructure.
Okay, thanks, Raj. Another question. Global markets have been swinging between recession fears and hope of peak rates. How do you see impact of global on India? I think Govind sir is on the call.
Yeah.
Govind sir, please. Shall I read it again? Govind sir?
Some technical issue, maybe, I don't know. What is the question, Sandeep?
Global markets have been swinging between recession fears and hope of peak rates. How do you see impact of global on India?
Well, I think, undoubtedly, the global economies are going to be under recession for this year. And it creates its own impact because India is not isolated, right? I mean, India will also have its own share of, some impact somewhere. But the good part is, when you look at India, you need to do the sector-wise analysis. Whether Indian IT sector will be impacted because IT is linked to the global economy's exports, 100% yes. That's the reason why IT stocks are down. Whether textile will be impacted because they are linked to the exports globally, of course it will be impacted, and therefore even textile companies are not doing well. So you need to look at sector-wise, and then you need to check whether my sector is going to be impacted or not. So rather than painting everything on the same brush, you need to differentiate between which sectors will be impacted the most and which sectors will not be impacted. Please also keep in mind that while the sectors and the economy growth may get impacted to a certain extent, how much it is already priced in. Last time I gave a detailed presentation on markets are always ahead of time. In last 50 years, there were 3 episodes where US market reported negative GDP growth. But in each of those years, S&P 500 and Dow Jones reported 18 to 20% positive returns. Why? Because 1 year back, when the growth was good, markets went down. Correct? So markets are always ahead of time. Remember 23rd March 2020, lockdown announcement, market went down 40%. COVID की मृत्यु जो death हुई, unfortunate जो death हुई, वो तो बाद में हुई. It happened in post June, am I right? But market was way ahead of time. So market is always ahead of time. So don't try to time out too much. There'll be some impact, but I don't think it will be meaningful thing from the market's perspective.
Okay, thanks, Raj. Another question from Ms. Anjali Vora. Banking sector has your major allocation. Do you think this sector can lead the next rally in the markets?
Well, I think I don't know about the. I think from here onward, at least next 12 to 18 months, it is not going to be single sector which is going to drive the market. I think it's going to be across thing, and it is going to be alpha fund manager approach. Remember 2020 and 21, throw the dart and make the money. I don't think that's going to work. Market will differentiate clearly between good and bad. Market will clearly differentiate between good growth and bad growth. Market will clearly differentiate between good management and bad management. Within sector, you will see big divergences. So I think it is not going to be sector-driven market. In my view, it is going to be bottom-up stocks which will drive the market from here on. And I'm not too much negative on any of the sectors except IT, where we are underweight, but then valuations are already down. So incrementally, we need to check it. And pharma, and there also the sector is already underperformed. So from here on, it is going to be alpha managers market. There are a number of opportunities which we are seeing, and that's how you make money from here on.
Okay. The next question from Mr. Neil Shah. Since you follow growth, did you not come across adding value stocks like ITC to your portfolio?
Good question. And being a FMCG analyst since 1996, so having spent almost 20, 30, 28 years in the FMCG sector, looking at it closely, I gave a skip. I think there are bigger, better opportunities, and value will perform if the growth gets attached to value. And while yes, ITC has some growth drivers, undoubtedly, we found many other better stocks which have a better growth opportunities and has also delivered extremely good returns for us in our portfolio. Like for example, we bought Trent about 2 years back, and Trent has done extremely well. And we bought more of Titan about 3 years back, and it has done extremely well for us. So I think objective is, can this company, particularly consumer space, can this company do 20%, 10 years compounded growth? What is required for that? So if you look at the cigarettes, what is the last 10 years volume growth? It's the Hindu rate of growth, 3%, 4%, price hike about 7 to 8%. That's where you get the growth. But if you look at the companies like Titan or companies like Trent, which we own in our portfolios, their organic revenue growth is 18, 20, 25%. For example, Trent, which is a West Side format, is 1.75 million square feet. And 4 years back, they created a new format called Zudio and added another 1.75 million square feet. Trent has added one more Trent in last 4 years. And that's the characteristics what we look forward when I talk about a longevity and the sustainability of the growth. And that's the characteristics what we love. And that's why we bought other companies instead of the name what you have mentioned. We keep looking at every company, but not yet bought.
Okay, thanks. The following question from follow-up question actually from Neil Shah only, Mr. Neil Shah. Can you give your comments on HDFC Bank versus ICICI Bank? Your views.
I think both are great institutes. We own both of them, and we like both of them. We continue to own. We have been holding these names from last. Of course, HDFC Bank we are holding from last 13 years. ICICI Bank in a big way we are holding from last 4 years. And we have been bullish on both these names. So there is nothing called versus. We are positive on both these names. We like both these names. We continue to own both these names. I think they both are well positioned in terms of the growth. They both have the best of the management practices in terms of the risk management. They both have the best of the, what I would say, next strategy to grow from here on for next 3, 4, 5 years. Look at the branch additions these banks are doing. Look at the kind of focus now they are doing on technology side, and so on and so forth. So, we are holding both these names.
Okay. There is one more question from Mr. Mahavir Karla. Mr. Your logic of investing in Nippon Nifty 50 B's ETF in AAA IOP.
Good question, sir. I think probably that's we are one of the unique of doing that. See, what happens is that, as I said, we are staggered in investment approach. At times, markets are uncertain, and companies, particularly it's few sectors and few companies, there we are not very positive, or we wait for the better entry point. but at the same time, we become bullish on the market. So what we do is that we don't want to sit on cash, and that's why we enter for a short-term tactical bet. We buy into the Nifty Bs. Say, for example, I want to buy XYZ stock, and XYZ stock is already, I'm thinking that I should buy, say, for example, 100 rupees, and current price is 115. So I'm waiting for my price to come because that's attractive price point, attractive valuation. But till the time, I don't want to keep cash idle. I would like to remain invested. And that's the reason why, for a very short term, as I said, for a tactical approach, we invest into the Nifty Bs, whereby we are invested in the market. At the same time, we are not in a hurry to buy today everything like model portfolio, because we don't believe in model portfolio. We are one of the few PMS. We don't believe in model portfolio. We buy today what we like today. So under that approach, that's the reason why at times you might see Nifty 50Bs ETF in our portfolio.
Thanks, Rajesh. Mr. Gautam Watway asking, how do you do a SIP in the PMS? What is the minimum amount for SIP in PMS?
Sandeep, you have to answer that.
Yeah, yeah. In fact, Gautam sir, for SIP in PMS, we need to first start a PMS with 50 lakhs, and then we can do additional SIP monthly or quarterly, whatever we choose. And the minimum investment amount for the SIP is 2 lakhs per month.
Perfect.
Mr. Rajendra Nandode what's mentioning no FMCG stocks.
Yes, we own FMCG stocks. We own many FMCG stocks, sir. So we own many consumer stocks, and few of them are also FMCG category. So we do own 2-3 FMCG stocks as well in our portfolio. If you are referring to AAA India Opportunity PMS plan. If you are referring to AAA Budding Beast PMS plan, there probably you may not see any large FMCG stock because primarily it is mid and small cap that we have to focus, and therefore you may not see any large FMCG stock in our Budding Beast portfolio. But we own 17% consumer sector even in our Budding Beast. So we own a lot of consumer stocks, at times discretionary, at times non-discretionary, at times building material, at times we exited then building material, and so on and so forth.
Thanks. The next question is last 1 to 3 year performance is good, but not big outperformance compared to the market indices. Why so?
Okay, good question again. I think very important is last 2-3 years in particular, the poor quality stocks have went up significantly compared to good quality stocks. We being focused on a good quality conscious, we do not want to compromise on it, and we wanted to stick to zero date, high ROE, market share, large market share, oligopoly. And if you actually do statistic analysis, the good companies have actually underperformed bad companies by as much as 30%. I don't know, Sandeep, in case if you have that slide here, let me check if I have a slide here. Give me 1 moment. And of course, one more thing, what has happened is oil, metal, and Adani. So if you look at FY 22, the BSE 500 is up 118%. But if you take out oil, metal, and Adani, which is 25% out of 118%, then the market is up only 85%. And we are up 113%. And as you are aware, we do not buy commodities and we do not buy poor balance sheet or governance or any companies like that. We have zero exposure to Adani since the last 13 years. And we don't buy oil, we don't buy metal. That's kind of discipline what we always believed in. At times, it results into little bit less outperformance or little bit maybe even underperformance, possible. But ultimately, as a trustee of your hard-earned money, what we believe is that we need to keep following our process, our philosophy consistently, and we need to make sure that we deliver long-term risk-adjusted returns. And that's the outcome of that. Is that that's why in 13 years we see low drawdowns in our PMS, whether it is a Russia-Ukraine war or whether it is a COVID time, our drawdown is much lesser compared to the markets. This is the slide which I was talking about, that if you look at the poor quality stocks, companies with no earnings growth, they went up 80%. Companies with good earnings growth went up only 60%. Companies with poor ROE went up 82%. Companies with good ROE went up 56%. Companies with high debt equity went up 88%. Companies with healthy balance sheet went up only 65%. That's the difference between good quality and poor quality. Poor quality stocks have went up like a huge outperformance. But we thought we should not compromise on our quality parameters, and that's the reason why we maintain our discipline. And it is that discipline which results into the less drawdowns. So if you look at last 13 years, there were 16 periods where market went down in a big way. But in most of those times, the blue bar fall was less than gray bar. We outperform. We outperform every time. And why? Despite 50% mid cap and small cap, because of quality and agility. And that's basically results into the low drawdown, less decline during volatile times of the market, whether it's a COVID time, whether it's a Russia-Ukraine time, whether it is a time pre-2018. That's basically our hallmark of our strategy.
The next question is, how do you see the impact of recession in corporate earnings growth in India?
I think I don't see any, as I said, one needs to be a little bit kind of a sector specific and, because every sector is going to have a different impact and then one needs to analyze what's the impact of it. So there might be some impact. In fact, as I said, it is going to be alpha manager year. So Nifty earnings growth may come down a little bit because Nifty has a oil, it has metals, it has a IT. Commodity prices are going to be a little bit under pressure. We don't own commodities. So for us, it is good. That's why I said it's going to be year of alpha managers. It is going to be year of bottom-up opportunities. And while the Nifty earnings growth may come down a little bit, it is not going to be disaster. So market is assuming, say, 13% earnings growth. Maybe come around 11.5 or 12%. Not bad, am I right? So I don't see any significant impact on overall corporate earnings growth. And that too, it will be primarily IT or commodities where we have a less presence or zero presence. So you need to really focus on the bottom-up opportunities and the bottom-up sectors.
Okay. The next question from Jinal Shah. How much more drawdown you expect in IT?
Very difficult to say, Jinal. Very difficult to say that. But we are watching it and we will see, how to go about it. We are underweight as of now, and we don't want to predict, in terms of the actual prices, what decline. We don't want to predict that. It is under our watch list, and we see how to go about it at right valuations.
Another question is, specialty chemicals was your favorite. Do you still like this space?
Sorry?
Specialty chemical was your favorite. Do you still like this space?
Oh yes, specialty chemical we continue to like. If you remember 1 year back exactly in our webinar, we said please differentiate between commodity chemical and specialty chemical. And if you are holding commodity chemicals, they are going to go down because those stocks went up like the roof. And that's what exactly has happened in last 1 year. We are holding the companies which are oligopolies, like for example, fluorine chemistry or ATBS chemistry and the companies like that. And in fact, few of my companies are at almost 52-week high. So we are remain bullish because China plus one is happening. The overall macro trends, the drivers of the specialty chemical sector, they continue to remain in our favor. And I think India will continue to see huge growth opportunity in specialty chemical side I'm talking about over next 5 to 10 years. It's going to be huge opportunity because even if you assume 5-7% shift from China to India, that's huge. That's really huge. It means 18-20% additional growth opportunity for Indian companies. And most Indian companies in specialty chemical side, they are doing high capital expenditure because they are getting entry into the global customers, agrochemical side, pharma side. They are getting the large projects. They are getting the commitments and they have a visibility of the new order books. So I think specialty chemical will continue to do well, but you need to be selective, of course.
Okay. Thanks, Rajesh. The next question: your budding based portfolio is outperforming strongly against index. How do you pick the right stocks in mid and small cap category while avoiding traps?
I think our investment philosophy and investment process remains the same. In fact, we are one of the few mid and small cap PMS. We do not own actually mid companies. All our portfolio companies are market leaders. We follow 3M approach. As I said, and I displayed in portfolio characteristics, all portfolio companies are large. Our average weighted market cap of our AAA budding beast is roughly 22,000 crores. They are really pretty large companies, but they are not in 1 to 100 by market cap as per regulator, and therefore they are not large caps, but they all are large companies by revenue, large companies by profit size. They all are, most of them are debt free. They have a high return on net worth. They have a high return on capital employed, and of course they have a high earnings growth. Our stock selection process, whether it is a IOP or Focus or Budding Beast or AIF, that remains same. No change in our investment philosophy, no change in our investment process. The QuAgility is what we breathe across our different products.
Thanks, Rajesh. The last question, in fact, there are questions many, but it's very difficult to accommodate all the questions. The last question for the evening is, how do you see mid cap and small cap versus large cap space for higher returns?
Well, if anybody has a 5 years plus view, I think it is an interesting space. Mid and small cap, probably, at least that's what I think. The valuations are in your favor. Of course, it requires a little bit more patience because at times this space can be a little bit more volatile. But from the growth perspective, it can have a higher growth opportunity compared to large cap because of the sheer size, am I right? And therefore, anybody with a little bit longer term time frame, we think that valuations of mid cap today, for example, they are below its last 10 years valuations. If you look at the return on capital employed of small cap index, there is a big gap 10 years back. You know, ROCE of Nifty was 18%, ROCE of small cap index was 12%. But today, ROCE of Nifty and small cap there's no big difference. And therefore, the valuation, the discount will not be there in the long term because ROCE has improved a huge. And on top of it, there is a growth. So I think it makes a very interesting case. If anybody's a 5 years plus view, you need to have a patience. That's what it demands patience from the investors.
Thanks, Rajesh. That's just your concluding remarks from you.
Well, thank you very much, everyone, for giving your valuable time in this webinar. And the conclusion remains same. We are fairly positive on Indian equity markets. We believe that the noise is the worst is over, the noise is over, and anybody with a 3 to 5 years view, there are a number of growth opportunities, there are a number of alpha opportunities, and of course, one needs to be, we remain agile to make sure that we don't fall into the quality traps, and that's also very, very important. We should not fall into value traps, and we should not fall also into quality traps. So QuAgility, we remain QuAgile to make sure that, we protect capital and create wealth. And, that's it from my side, and wish you, all the best for your future careers. And, with that, probably we'll conclude this webinar.
Thank you all. Thanks, Rajesh. I'd like to thank everybody who joined, taken the time out their schedule. Thanks you all. Happy investing.
Thank you, everyone. Bye-bye.
Thank you.